Imagine applying for business insurance tomorrow. The underwriter reviewing your file has never met you. They don't know your work ethic. They don't know how passionate you are about the business. They only see patterns. From those patterns, they have to answer one question. How likely is this business to produce a claim? We're going to explore how insurers actually evaluate your business structure. Not the theory, the process. We'll look at what information they examine, what patterns they interpret, and why some businesses that believed they were protected discovered during litigation that the structure never truly separated them from the company. Because insurance companies operate on probability. One way to understand underwriting is to think about weather forecasting. Meteorologists can't guarantee that a storm is going to happen. Temperature, air pressure, wind movement, these signals allow them to estimate probability. Insurance underwriting works the same way. Underwriters analyze patterns inside a business that historically produced claims. They're not evaluating whether you intend to run the business responsibly. They're evaluating whether the structure and behavior of the business suggests future risk. And they do that long before anything goes wrong. When an insurance company reviews a business, the underwriter is trying to answer three questions. How likely is this business to experience a loss? How severe could that loss be? And how predictable is the company's behavior? Those three questions determine the entire insurance decision. Coverage, premium, limits, exclusion, everything flows from the underwriter's risk classification. Every industry carries historical loss data. Restaurants, construction companies, transportation businesses, manufacturing, professional services even. Underwriters analyze decades of claims history across those industries. This creates a baseline risk score. For example, construction companies statistically produce more injury claims than consulting firms. So, a construction company begins with a higher baseline risk. But the industry alone doesn't determine the final classification. The underwriter then evaluates that specific business. Next, the underwriter examines how the business operates. They review ownership structure, management hierarchy, employee roles, operational procedures, because disorganized operational structures correlate with higher claim frequency. If authority is unclear, mistakes are more likely. If supervision is inconsistent, accidents increase. If the training is informal, liability exposure grows. Operational discipline reduces risk, while operational confusion increases it. Think about airline pilots. Commercial aviation is extremely complex environment, yet accidents are rare. Why? Because pilots follow strict operational procedures. Checklist, authority hierarchies, communication protocols. These systems reduce human error. Businesses work the same way. Clear operational systems reduces liability. Loose structures increase it. Underwriters evaluate these systems carefully. Insurance companies also evaluate financial signals because financially unstable businesses produce more claims. Why? Financial stress increases operational shortcuts. Maintenance gets delayed. Training gets skipped. Safety procedures get ignored. Underwriters review financial statements to determine whether the company operates under constant pressure. Businesses that struggle financially tend to generate higher loss rates. So financial stability becomes part of the risk profile. At this point, it should start to feel familiar. Insurance companies aren't evaluating the business the same way that founders do. Founders focus on opportunity. Underwriters, they focus on probability. The founder asks, can this business succeed? The underwriter, on the other hand, asks, how likely is this business to produce a claim? Those are very different perspectives. Underwriters also analyze historical claims. Even minor incidents matter. Frequent small claims signal operational weaknesses. Not just bad luck, patterns. If a company repeatedly produces claims, insurers assume the underlying structure creates those outcomes. Past behavior predicts future losses. So claims history becomes one of the strongest indicators in the risk profile. Insurance companies also evaluate how businesses control risk. Safety policies, training programs, maintenance schedules, quality control procedures. Those systems demonstrate whether the company actively reduces risk. Businesses with strong internal controls receive better insurance terms because they demonstrate predictability. And predictability reduces uncertainty. Once the underwriter builds the risk profile, the insurance company responds in several ways. Higher premiums, lower coverage limits, specific exclusions, or additional requirements, or in extreme cases, denial of coverage. The insurer is not punishing the business, it's pricing the probability of loss. If you're launching a business, this episode reveals something important. Risk classification begins early, long before the first claim. Operational discipline matters from the beginning. And if you're already operating a business, well, this episode helps you understand how insurers interpret your company, because insurance companies rarely explain their conclusions. They simply adjust the premium. Insurance companies don't wait for problems. They evaluate the probability of problems. They analyze operational structure, financial behavior, claims history, risk controls. From those signals, they build a profile of the business, a profile that determines how the company is going to be insured. Understanding how underwriters think reveals something very powerful. Your business is constantly being evaluated by institutions, often quietly, often long before you realize it. And those evaluations shape the opportunities available to your company.